Head of Strategy and Head of India Equity Research and Asia Pacific Research at Bank of America Merrill Lynch, India, which is Amish Shah. And he's put out a report a few days back wherein he argues about a few post-COVID themes, some of which might seem fairly straightforward, and some of which are interesting because they have been spoken about in the past in other guises. And now Amish believes get a sense you think the market implementation. But thanks so much for joining out here at Bloomberg. This is Neeraj here. Good morning. What's your sense of whether COVID-19 has kind of accelerated a few themes in your mind, which maybe but now would have to clear? Is that pieces of this report?
Sure. Thanks, Neeraj. Good morning, first of all. Let me begin with saying that, as we've often heard, that India reforms the most during crisis. And what we're trying to do through this report is trying to identify themes that could change structurally within India once the COVID crisis is over. As a central theme, we believe that the cash crunch that is created by COVID would impact the finances of businesses as well as the government. And that could lead to 4 key structural changes within India. To begin with, the first trend that we think would be a second wave of consolidation in favor of the organized players across a variety of sectors. Second, we think that will be disintermediation within the value chain, again across a variety of sectors. Third, we think that there could be large asset sales within real estate and infrastructure sector, and possibly these assets would be sold to sovereign funds, pension funds, PE funds. And then lastly, we believe that the cash crunch created for the government would lead to more formalization of jobs, and that would make the government subsidy distribution better targeted. And then besides, given the global shifts and with global firms wanting to diversify out of China, I think India will play a critical role in trying to attract manufacturing investments. Obviously, that is subject to certain reforms that India needs to do first. And then lastly, we think that the newly established habits that we have now during COVID would probably stick on, and the consumer behavior would change, favoring more online and digital platforms and growing an aversion towards crowds in general.
Okay, interesting. Let's try and probe some of these. I want to first start off with the fifth theme of sorts that you mentioned, which is Make in India. And the reason I want to talk about this is because this is often debated, much spoken about since the last few years by the government themselves about the clear push from the government side for inviting companies to make in India. And you have to say that it hasn't quite succeeded thus far. Why are you, if you are indeed bullish on this now, why is it that that's the case?
That's a very fair question, Neeraj, and you are absolutely right. In our report, we are also not arguing that Make in India definitely succeeds even this time. In my opening remarks, as I said, that there are certain things that India needs to do right. So let's explore those. I think that the long-standing asks of global firms to come into India, and why only global firms, even the Indian industries continue to ask for better labor reforms, power sector reforms, and land acquisition getting simpler. All of these three, as we understand, are broadly the factors of production. And that is something that India needs to get right in order to be even able to attract these investments. But that said, why do we still put it out as a theme? We put it out as a theme because we think that India, to some extent, is doing some things right over the last few years. So, for instance, did you know that India has already doubled its transportation infrastructure capacities in terms of highways, railways, and ports? It is already got doubled over the last decade, and which is more capacity adds over the last 10 years versus 60 years prior to that put together. And this has been done on the back of a 143% increase in transportation infrastructure over the past 5 years, which I think is a great deal. And on the back of that, the infrastructure deficit that most global companies complain within India has already halved. And we are not stopping at that. Given that we are continuously increasing our budgets towards more highways and railways, I think over a period of 2 to 3 years, by the time these global firms set up factories, these deficits will keep on becoming even narrower. As a matter of fact, in certain corridors, like the dedicated freight corridor, which connects broadly Bombay to Delhi and Delhi to Calcutta, in that corridor, I would argue that India will have a surplus of railway capacity. So from an infrastructure deficit country to infrastructure surplus, even in few corridors, is quite a statement. So that's number one. Number two, we already know that India is in an advanced stage of reforming the power sector as well as the labor laws. Labor laws, as you know, is already in the parliament. Power sector draft changes are already uploaded on Ministry of Power's website for comments, and they could soon be taken for cabinet approval, and subsequent to that can get into parliament. So those things are progressing fine. And then I would say that this is perhaps the only time where, versus only being a pull from India to get investments from the global firms, there is this time, and this is perhaps the only time where there is a push within the global firms as well to diversify out of China, because they've seen supply chain disruptions happen during the COVID crisis. And then lastly, maybe we can dwell into more details later, but I would say that, broadly, you can cut Make in India into two parts. One is about attracting foreign investments to set up factories within India. The second, and more equally important, is also import substitution. So you would have seen that within the consumer electronics, coal sector, defense sector, and pharma sector, there has been spate of government policy changes over the last couple of years, including some very recently. And those four sectors put together is about 15% of India's import bill. And we can localize these things within India. So if we do that, that I think is also a big needle shift.
Okay, let's dwell on some of these, because this is arguably the most hotly debated topic, Amish. A point that you made first, which is about the push out of. Let's tackle that first, and then we'll come to policy within. You guys have a global team. In your assessment of you out here in India and your global partners, are companies which are looking to move out of China, let's say, for whatever reason, and multiple reasons, looking at India as a destination at all? I remember one survey that was done either by Merrill or by BlackRock saying that some 1,000 companies, and a lot of people cited Southeast Asia and India individually. But we haven't seen telltale evidence of that in the last 2 months or in the last 12 or 18 months, wherein a lot of companies have moved to Vietnam, Bangladesh, etc., but haven't quite set up manufacturing bases in India. What is your study telling you?
Sure. So, Neeraj, that's a very fair question. And since you cited our global report, let me first give you the background to it. So we surveyed all our global analysts, and who in turn went to their respective companies globally to ask whether they will want to shift out of China. And if they do, where will they consider moving to? So this is a total survey of 3,000 companies globally. And, there were two kinds of answers. One was that US companies wanted to localize within US. And then the ones which wanted to move out, Mexico, Vietnam, and India came right at the top. And this survey was actually just prior to COVID, so we did it at the beginning of this year. So there was nothing to do with COVID at that point in time. Subsequent to that, if you think about it, I would say that during COVID, let's understand the disruptions that happened. So I'm sure you would have heard that, a lot of auto factories, both in Japan and in Korea, had to be completely shut when China was experiencing the first phase of infections, because a lot of their supplies come from China. Similarly, a lot of mobile manufacturers globally had to shut their retail shops because a large part of the manufacturing of their phones happened in China. So even when the virus was not globally spread, because China was impacted, the global operations just came to a standstill. Take an example more closer to home. Within India, initially we faced problems within consumer durables. We faced problems even within pharma sector, because a lot of the APIs, or intermediates as we call it, which is a raw material for making medicines, 70% of that comes from China for India, right? So with the disruptions that people have seen, and given the background, going back to my global report, that in the board meetings, these global companies were anyways contemplating to move out of China. Add to that the fact that now you have witnessed the disruptions, and you've seen that if you are only dependent on one country, what could be the supply side challenges, I think that this could be fast tracked. And that, to add to that now, a lot of the labor reforms, power reforms, a lot of these announcements within the four sectors that I spoke about are subsequent to that. So I think that progress is happening. At what pace we could probably say over a period of time, depending on how soon it moves. But I can clearly see that there is progress happening.
You would be happy, Amish, if this takes place over the course of the next 2-3 years, because a lot of people would want immediacy in results, but these things may not happen immediately. Would you reckon that you, as somebody who observes this, would be happy even if this happens 2-3 years out?
Sure, Neeraj. So look, the first signs of it would be obviously talks and dialogues increasing, right? Because obviously a physical factory on the ground is obviously many years out.
Yeah.
But so the way we would look at it is, first, are there enough signs to suggest that India is moving on issues that needs to be resolved fast? And at this point in time, it seems to me that it is a yes, right? The subsequent stage to that is that on the back of that, are global firms at least engaging with India? Okay. And if the answer to that is a yes, then the probability of these things happening goes up manifold. And let me again bring into the discussion the import substitution that I was talking about. So let me just take a simple example of consumer electronics out of the four sectors. Consumer electronics for India is the largest import after oil as of now. And over the last 5 years, consumer electronics imports have doubled. Even before the COVID crisis and even before the latest policy that they've gotten around production-linked incentives, the government was doing the old-fashioned way of increasing import duties on components and finished products. And on the back of that, over the last 5 years, domestic production for consumer electronics in India has now almost equaled to that of imports. So it's almost 50-50 ratio now, which is, I think, a pretty big move. And now, look, some critics would say that, we are only predominantly doing assembly and we are not doing the high-end stuff, but that's how value chains build up, right? Even within autos, where we are mostly now self-sufficient, it never started with we building the complete car to begin with, right? It was assembly to begin with, and then we started doing a completely knockdown units as we are at this point in time. So I think the beginning has to be made, and even that beginning in the value chain can be a pretty big delta mover from where India is currently.
Okay, interesting. Well, we have a bull out here and a hopeful out here. Let me put it that way, and that's actually good news. I mean, yeah, some of these data points are truly interesting. Amish, just one quick follow-up. In your assessment, or if you have any insights into, by virtue of your talks with your global partners in Southeast Asia or otherwise, what's the difference between companies being able to attract global manufacturers, or countries being able to attract global manufacturers, say in the Southeast Asian region, versus India? Would it be essentially these reforms, which is labor, land, and infrastructure? And would that be alone to give India a reasonable competitive edge, which was missing in the last, say, 24 to 36 months?
So, Neeraj, I would say this is now become a very complex subject. So land, labor, power, I think, are the basics that we need to fix. But taking your discussion or question forward, so the things at play now. So let's say whether the factories are environmentally degraded, or are they, are they in favor of environment? That's a concern number one right now.
Yeah.
Is the industry high tech, or is it more labor tech? Right. Mm-hmm. The third thing is, can we be automating these factories, or is it not going to be automated? The fourth thing is, does it require extensive logistics? Like, let's say, certain components getting manufactured in some part of the world and comes through assembly to India, and then again goes to somewhere else to get a finished product, and then finally gets shipped out to the end markets. So what kind of logistics supply chain that you're talking about? And then you add to the mix, what is the kind of energy that they're going to use? Is it going to be more shale gas, where US will obviously have an edge? Is it going to be more power dependent? Is it going to be some other fuel, like maybe, let's say, natural gas? So there are a variety of factors at play here. And unfortunately, therefore, it is difficult to say, just land, labor, power. But what I'm trying to say is that land, labor, power is a beginning with which you'll have to start. And just to give you an example, there might be an industry that wants to come to India, which is predominantly an export-oriented unit. So he might be better off coming up in an SEZ close to a port, because he can completely cut down on the transportation costs. He manufactures there, puts his stuff straight on the port, and there he saves a lot of his logistics costs and time. So so the solutions will have to be more tailor-made for the kind of industry that you're trying to attract. But I'm again just repeating that we'll at least have to give a comfort that the basics related to land labor power are at least in place.
Yeah, well, long drawn subject. We can go on, but I think this was nice to just get a sense of where we are. And it seems, I mean, one only hopes that India builds on to some of these moves that have been done, Amish. The next one that you've spoken about in your theme is infrastructure and real estate, right? And it's interesting simply because the last, I think, 2 decades now, we've been argued about how infrastructure and real estate, big employment generators, need capital. Some of those got capital in the past as well, and currently are at a juncture wherein things are probably not looking all the best. People are writing obituaries for real estate. What's your reckoning? The next 3 years versus, or the next 5 years versus the last 5 years, infrastructure and real estate?
Sure. So I would say that there will be 2 things that will play out. One will be that about consolidation, and the second would be even more drastic, about the kind of asset owners itself will change. Let me get into the details of that. So, and maybe let me give you some statistics to give you a background first of all. So we looked at all the listed companies within the infrastructure space, and largely we realized that the capex phase in India started since 2005. So since 2005 to 2015, which is a 10-year period, when we look at the equity capital that is being raised by these infra companies, it was up 41% CAGR over a 10-year period. So it's a pretty big growth, right? In comparison to that, over the last 5 years, the same set of infra players have got a 0% equity infusion from investors. Okay, that tells you something about risk aversion, number one. Number two, if you look at a similar period, the loans that they were able to get from the banking system was up 23% CAGR. It's now down to 3%, right? So what has happened, Neeraj, is till 2015, there was a massive asset creation phase, which led to a lot of leverage. And we are now entering a phase where people are trying to consolidate, and they're trying to reduce the leverage on their balance sheets. They're trying to sell assets in order to delever. And incrementally, whether you're an equity investor or a lender, you are not interested to give more capital till the time you see that the balance sheets have got repaired and the incremental dollar going in is not going to turn bad, right? Now, post-COVID, in an environment where potentially NPAs could rise, and even probably from the retail segment, which is so far considered to be relatively safe, I think that equity investors as well as lenders can only turn more risk averse. And in an era, basically what that would then mean is that the most capital hungry sectors like real estate and infrastructure, as you spoke about, I think will turn the most capital starved. And as that happens, these players will have no option but to sell their assets, or they sell their entire businesses perhaps, right? And that's where I said that there could be consolidation if they completely sell their businesses. Coming onto the assets front, again, as I said in my opening remarks, I think it could probably get sold to the sovereign funds, pension funds, and PE funds. And now let me come to why I said that. So if you look at a sovereign fund or a pension fund, what is it that they need? They need 3 things particularly. Number one, they need some long-term investments, which is perfectly where infrastructure projects fit in, because generally an infrastructure project has a life of 15 to 50 years, right? So number one. Number two, they typically want something which is less risky. So I would argue that an under construction project in India is very risky, but an operating project, infrastructure project in India is relatively risk-free, right? And then the third thing that the pension funds or sovereign funds would look for is a stable yield, which is higher than their cost of funds. So as far as they can justify making a decent spread of profits over their cost of funds, that will be a good investment. And infrastructure and real estate projects have the potential of exactly offering that, all the three factors. So I think that the sales to these funds will go up, and that could be round one. In the round two, once these funds have acquired a decent portfolio of assets, I think they may want to recycle their capital by going to InvITs or REITs kind of structures, which are more yield generating. And now, therefore, connecting all that you asked in the question, I think with this wave, and it will take some years to go through, but you will have a complete new set of infrastructure or real estate asset owners, and those who are chasing more yield based returns versus the growth based returns that we look for in these assets right now. Neeraj, I'm sorry to interrupt, but I lost your audio.
Amish, can you hear me now?
Yes, I can hear you now.
Okay. Amish, what happens to the list? You summed up almost everything that I wanted to hear. Just one quick follow-up. What happens to the real estate space and people who are chasing growth out there? Simply because some of these players do have decent balance sheets compared to others. Would they also be starved of capital? And two, almost everybody argues for real estate prices going down. I don't know if you guys have thoughts out there, but could that alter the landscape for companies which are not necessarily looking to operate in a yield-based structure?
Sure. So, Neeraj, I would say that the good quality companies will survive and thrive, and they are the ones which will play the role of consolidators. And then there'll be other set of companies which were not organized. They don't have access to institutional funding. Their balance sheets are highly levered. Unfortunately, I think that they will have no option but to sell out. Because think of it like this: that if you are a real estate home buyer, you don't, in this point of time, don't want to risk your money giving money to a developer where you're not confident that the project will come up in the first place. But at the same time, a good quality developer, even if he asks you a 5% premium realization to the ongoing circle rate in that area, you would probably give it to them, because you would say that, you know what, the project getting delayed by 1 year is more than the 5% extra that he's asking me for, right? Because your mortgage rate will more than cover up for that. So the point being that for an organized company, if you look at most of them, their cost of borrowing currently is less than 8%. Compare that to the unorganized player, where the cost of borrowing is upwards of 15 to 20%, and even at those rates, they are not getting money. So there's a big 12% differential of cost that we are talking about to begin with, number one. Number two, as I said, so on the cost, he is cheaper, and on the realizations, he can charge you a premium and therefore make better margins and better returns. And on the back of that, obviously more capital, both from equity investors and lenders, would flow in, because it's a well-run company making good returns, having good cash flows. And yes, you're right that maybe the whole real estate pie in terms of volumes will shrink at this point in time. But the point is, who gains more share within the same pie or a contracted pie? And as per our numbers, only 11% of the real estate industry right now is represented by organized players. So that basically means that even if the pie shrinks, there is a very big market out there for the organized players to continue to grow and consolidate.
Okay. Amish, the next theme is disintermediation of wholesalers. Now, just dwell on this a bit. Tell us first, why do you believe this will happen, and who would benefit, who would lose out? I'm guessing that the companies which are probably setting up direct outlets benefit, therefore, but are there some offshoots to this as well?
Sure. So as a background, Neeraj, again, wholesalers broadly is about 30 to 40% of the value chain for most industries. And most of these wholesalers operate on a very thin margin. They are mostly unorganized, so even they don't have access to institutional funds which are cheaper. And over and above that, technology now makes it possible for brands to reach retailers or customers directly. So you don't need the wholesalers in between, which is the old generation where there was no technology at play, right? Let me give you a simple example that we can all relate to. All of us are used to buying our medicines from a local chemist shop, but I'm pretty sure that a lot of us have now migrated to buying it through an app. So what is an app essentially trying to do is that it's trying to connect the brand or the pharma company directly to you as a customer, and in the process has disintermediated the value chain, right? And the margins that they've saved by not having the disintermediated mediation in between is what they're passing on to you as a discount, right? So you as a customer benefit, the pharma brand benefits, and on the back of that, they also get some data on you in terms of what kind of medicines that you consume. And the same example I would probably say you can take on to a variety of sectors, whether it is FMCG, whether it's consumer electricals, a whole variety of sectors goes to the same chain. And I would say that, the recent announcements that the FM made around APMC reforms would probably do the same thing in the agriculture sector, because we all know that the farmers get far less price for their produce because the middleman in between makes the biggest margin. But what the APMC reforms are aiming to do is basically make an online platform where they connect the farmer straight to the consumer. When I'm saying consumer, it could be the aggregators like, let's say, Big Basket or those kinds. But once you do that, a large part of the value chain gets disintermediated. The farmer gets a better price for his produce. You probably get the fresh products cheaper. So in a variety of sectors, we think more particularly within FMCG, retail, pharma, agriculture, consumer electricals, pipes, all of these industries, I think that trend would probably play out.
Okay, and just a follow-up, I don't know if you have thoughts here right now, Amish, but just a follow-up, would you reckon that some of these sectors have individual tailwinds or headwinds as well? So disintermediation will not be necessarily the only thing that will drive. Where is it that all things are falling in place for a sector? Do you have thoughts here at all, or would it be your individual analysts? Would you have thought? Who would have thoughts here?
Sure. So Neeraj, I think that's something which is already in play, and right since the time GST came into play is the theme of consolidation. We've all heard about this theme, but I think it is still ongoing and will continue to play on for many years. Again, just as a statistics for background, we looked at 1125 listed companies, and what we tried to see is that what is the market share of the top 5 players in a particular industry. What we note is that post GST, which probably came around middle of 2017, market share has been going up by approximately a percentage point each year, right? Now, we try to see that what could be driving this. And I would say that the two main points that came to our notice, amongst a variety of other factors as well, is A, the organized players have an access to technology on the back of which they are able to do data analytics, and they are able to cut costs, and they are able to cut down on their working capital cycle, which is exactly what the unorganized companies are not able to do. Over and above that, post demonetization, post GST, and a variety of other laws that have come in, the regulation cost, compliance cost, taxation, all of these are increasing for the unorganized players. So on one end, you have a dynamic where the organized firms are able to lower their working capital cycle and lower their cost structure. On the other hand, the unorganized players are only increasing their cost structure and increasing their working capital cycle. And in an environment like this, where particularly cash has become quite constrained because of the lockdowns, the retail sales couldn't happen, and therefore obviously cash is going to be a constraint at this point in time. So think of it like this, that an organized player is going to be in a much better shape to offer better or extended credit terms to its distributors, which an unorganized player will fail to do. And as that happens, I think by the rule of the business, I think consolidation in a lot of sectors will now only accelerate versus the 1% run rate that we've been seeing on the last 2.5 years.
Okay, Amish, just one final question, and that is on one more theme that you said, which is formalization of jobs. I don't know if it's probably important to the country, not so much for within the listed space, so to say, but quick thoughts here. Why do you think this will happen?
Sure.
It's a big ask or a big statement you're making.
So Neeraj, again, in India, there are 470 million jobs. 90% of this are informal. When I'm saying informal, it basically means that these guys don't have a formal job contract like the way you and me have, which basically means that they don't have good social security benefits structure attached to their jobs. Number one. Number two, these are jobs which are not connected to Aadhaar card or a bank account or a provident fund account. In other words, there is no way for the government to reach them directly, right? And in an environment like COVID, the government wants to help out these people, but how should the government do it? Because they don't know that, let's say, your driver, what's his bank account, what kind of earnings does it have, does it require a lot of support or minimalistic support, what kind of support does he need, does it require more healthcare facilities, does it require more food supplies? There is just not no data available on these guys. What we are therefore arguing is that the government could probably go for job formalization, which will basically be a structure where jobs get registered. They will have a registration number, and that number gets linked to their Aadhaar card, bank account, provident fund account, so on and so forth. Once you have this structure, then the government can have the subsidy distribution very well targeted, of saying that somebody who earns, let's say, 10,000 rupees per month needs more subsidy than the person who earns 30,000 rupees per month, as an example, right?
Sure.
And as these subsidies get better targeted, there will in fact be savings on subsidies, because currently some of the subsidies also reach to those people who don't need it at all, right?
Sure.
And if you look at the government expenditure pie currently, 76% of the government expenditure is fixed in nature. So those are predominantly the government employees' salaries, administration costs, interest payments on the loans that the government has taken, so on and so forth. The remaining 24% is broadly equally split between capex and subsidies. So if you can make the subsidy distribution more targeted or better targeted, then the money saved there could eventually turn into doing more capex, which is again coming back to our Make in India theme, and it all forms into a nice cycle as a country.
Well, long drawn reforms, some of these would be better done as soon as possible. But Amish, we certainly hope that things turn out even more quicker than what probably you or some of the others are envisaging. But thank you so much for joining us today on BloombergQuint and giving us a sense of what the post-COVID-19 themes could look like.
Pleasure, Nilesh. Thank you.
Thanks for your time. And viewers, thanks for tuning into this broadcast.
Thanks.
Thank you, Amish. Pleasure.